Hi there, and welcome to the channel. Hope you're having a good festive season, and we're almost at the end of the year. It's time to look at portfolios and just see how things are going. Keep track of are we still on track for everything. What I'd like to talk about today, I've heard a new thing. The typical asset allocation going like into retirement or even before retirement, 10 years before retirement, there's a new thing that's come out that someone has recommended. Obviously, everything that's mentioned here is not financial advice, so do your own research on everything. But it's just interesting that they've come out with a thing saying normally you get your asset allocation is maybe like 80-20 or 70-30, the higher number being the equities and the lower number being bonds or cash type investments. So fixed deposits, bonds, CDs, money market, stuff like that. Obviously, when you get to retirement, you need the liquidity, so you need the cash. But now, what they've recommended doing, and as far as I can understand, they're talking about even before retirement and going into retirement, is a 30-70. Now, for me, that is not right, and I'll explain to you why. So they're talking about 30% equities and 70% bonds and cash type things. So investments, assets. So what you do, if you need your equities for growth, and obviously dividends as well. So you need that part of your portfolio. And if you have 30%, in my opinion, if you've got 30% only in equities, being growth and dividend equities, and 70% in bonds and cash, okay, it gives you enough cash. Although if you're totally in bonds, it can also be a problem for your liquidity. So I'll also explain that to you. How it works, your equities is where you get your growth, because you're sharing in the company's profits. You invest in companies, and you own a small part of the company with each share you own, and the companies pay out dividends. So you get your dividends as part of they get paid out of profits, out of the cash flow, or they grow. In other words, they grow internally. They grow their intrinsic value. They grow over time. They invest, instead of paying out dividends, they reinvest in themselves, and they grow, and they become more profitable and make more money over time and get more cash flow. So yeah, you do definitely need that. But why I'm saying that the bonds are a very good investment. It's a fixed interest investment. It's a loan usually from the government or from a company. So the government issues bonds, and then people will buy the bonds. They issue at a certain interest rate. Now, the reason I say this is interest rates go up and interest rates go down. They move in cycles. At the moment, we're currently on a downward cycle. In South Africa, we were at about 11%, roughly, and now we're sitting at about 8.4 for the 10-year. In America, then bond yields are a bit lower. The inflation is usually a little bit lower than ours, and in America, you're sitting with probably about a 4% bond. Now, compared to the stock market, your stock market returns also not guaranteed, and you can have up and down years, but your stock market, you can reasonably expect in the region of 8 to 12% return on the stock market. That's an average return. Like I say, some years you'd be more, some years you'd be down. The stock market, the reason I think that they're talking about the 30-70 is because there's more volatility in stocks, which is true. The stocks are more volatile than bonds. But what they're neglecting to think about is bonds can also be volatile. In other words, let's say you retire and you buy a bond and you've got a low interest rate, like 1 or 2%, say for example, and interest rates go up. Now if you've got only bonds, so you're getting your interest from your bonds, but obviously you will need to sell some bonds to survive. But the problem is, if interest rates go up, the value of your bonds go down. So when the yield goes up, the price goes down. And inversely, when the yields are coming down, like it is now, the price is going up. So it is a risk as well. Trying to say that bonds are more stable, to an extent it is true, but also it can, if interest rates go against you, then your bonds can actually lose money. What happens if you sell at maturity? So if you own an individual bond and you sell at maturity, then you get your principal plus the interest. But the reason that the prices go down is because if you buy a bond at, let's say an extreme example, you buy a bond at 1% and the interest rates go up to say 10%. Then someone buying a bond now gets 10% yield on their investment, fixed, where you've got only 1%. So if they buy your bond, they will want to pay less because you're only getting 1% on your bond is 1%, and they can get 10% if they buy a new one. So obviously the price will go down to sort of balance that out. So that's why I'm just saying I'm not sure if that is a good way. I'd like to hear your views on what you think is the correct allocation. Yeah, I'll obviously see how things go, but I think probably 70-30 is probably a good one, maybe 60-40. But also, what you actually do need is more sort of, you obviously need long-term bonds and short-term bonds. Your short-term bonds, you get a slightly lower rate, but the interest rate won't change as much. Obviously, if you take a loan for 3 months, the rate's pretty stable. It will change if interest rates change, but it's more stable than a 10-year or a 20-year or a 30-year. 20-year, 30 years is over 9% in South Africa. So what they're doing is, obviously you're taking more of a risk taking a longer term bond because it's longer to pay off. You don't know what's going to happen in 30 years time. So that's why they give you a higher rate. So yeah, so it's interesting to see that they come out with that saying, and one of the analysts, I don't want to mention the name, but he said, no, it's a good thing. And then there's another one who said that 100% in equities is a good thing, but your like I say, your equities are more unstable. So if you retire with 100% equities, then if you don't earn enough with dividends to live off, then you're going to have to sell shares. And then if the stock market drops, say 30%, then you have to sell at a loss. So that's also why you don't want 100%. What I think is like maybe 70-30, but of that 30%, maybe 10 to 15% in short-term bonds like money markets and stuff, to have that cash available. And if you take that money out there, then you won't be affected by interest rates and price swings on the interest rates. So yeah, that's just quite interesting. And I don't think a lot of people explain this about bonds. You know, they just think, oh, it's much safer, they can just buy bonds. But there are cycles to your interest rates. And currently we're on the way down. And we'll get to a stage where I know in America they want it lower. Obviously, the governments have debt. The government debt is getting out of hand because they're overspending. And now they need to try and pay that debt off. And the interest on the debt is actually becoming almost unmanageable. And you'll see now there's the US government just issued another bond to obviously with this debt story, and they're printing money. If you look at the M3 money supply, you'll see it just goes straight up like that. Every month they printing more money, which increases inflation and devalues the currency as well. Our rand recently has been a bit stronger against the dollar because the dollar has been so weak. So that is one reason, but it's a good thing because also money is coming into the country. The gold, silver, all our minerals and stuff, which is a lot from South Africa, obviously other countries as well. Money's coming into the country. People are investing in the country, which is good. So even our rating, we've come off the grey list. So that's a positive thing. That's what's strengthening our rand as well as the dollar weakness. So yeah. But what you need to do is just take note of the swings in. Okay, so another thing I want to talk about as well is when you retire, people think of retirement as the finish line. For example, you get to the finish line, you retire, that's it. But it's actually not the case. If you remember the movie Forrest Gump, Forrest got the ball, caught the ball, and he just ran. And then he got to the goalpost and he kept running and he kept running. People said, no, you stopped, you scored, you and he kept running and he kept running and he actually kept running for years. Now, retirement is like this. The retirement is not the finish line. It's just the goalpost to start a new chapter. And you do live for maybe 10, 20, 30 years after retirement. So you need to have your asset allocation, like I was talking about your bonds and your equities. You need to have your, don't think about it only up until the day you retire, be it 55, 60, 65 or whatever age. You have to actually think into the future. Almost think of your retirement as a business. And then you have to, obviously, you save up and then you need to live off that in your retirement years. So you live off your dividend income. If you've got like a RA, pension funds and stuff, you live off the annuity income. And there's different ways to do that. Living annuity, there's a life annuity. But if you want me to talk about that, I can talk about that on another podcast, or whatever you guys want me to talk about. It's not a problem. I'll discuss this, go into more detail. Okay, so have a wonderful time, and season's greetings that go around there. Okay, so like and subscribe to the channel, and I hope to build up my followers and give you some good content. What you're actually looking for, you can tell me. I'll try and cover most things, finance, but even other subjects I'll cover. Yeah. But I think investing is a long-term thing. You buy your shares. It's like a piece of soap. If the more transactions you do, the more you use the soap, the smaller it becomes. If you leave the soap, it stays the same size. And with investing, you're hoping it grows. It's like planting a seed, and the tree will grow eventually. If you plant a tree, now if you look at investing, if you plant a tree, if you go dig up the seed every 2 days and have a look to see what's going on, then it's never going to grow. What you have to do is you plant your seed, you have faith in it, you trust it, and you reap the results in years to come. So have a wonderful time and see you next time. And don't forget, like and subscribe.